statistical indicators basically that would indicate you buy or sell a particular stock, or technical analysis.
Okay.
So basically using maths to trade and make money out of it.
Right. Part of it. Yes. So what we do in quant trading? So let me give you. This is something not applicable to just your pair trading. It is to the every other kind of the quant trading we do. Something it could be in say options. It could be a It could be a trend following system or any system. What we do is first formulate a hypothesis. Now what is a hypothesis? Hypothesis formulation is something like you say, okay, if these things happen, then my market will go up. If these things will not happen, my market will go down. Or you have certain rules that you can define for your markets to behave like. So that is what we call hypothesis formulation. So first we do a hypothesis formulation. Here the hypothesis formulation for us in a pair trading would be something like, is that a particular stock, say in particular stocks like Infosys and TCS, which belong to the same sector, and they have a similar kind of behavior. Both companies have similar kind of business model and everything. So if say Infosys is going up, is that the TCS will also go up? If it is not going up, or the TCS will lag behind. So we look at all those kind of stuff. So this is our hypothesis formulation. Next, we do the backtesting and hypothesis verification. So backtesting is something which is the core of any quantitative trading strategy. I'm sure many of you guys will be moving into the trading side of the business, and you will be constantly be put up against these things, backtesting, and this is something which I tell you is the most tedious and most frustrating, I would also say, because many times your results are not up to what your hypothesis is trying to put to you. So we go through this backtesting and the hypothesis which is being verified, and hypothesis backtesting then. And the third is parameter optimization. Then if something in our backtesting does not work well, then we look for the parameter optimization. I'll take you through the whole process, how we go and do it in a pair trading scenario. And then finally we go live with the strategy. Okay, so let's move ahead. So, premise of statistical arbitrage, the stats arb, which we call in short, is harness statistical mispricing of a set of securities which we look to exploit. Stat arb's pair trading involves going long on a stock and shorting its competitor as a hedge. Okay, so what we do is, suppose we decide upon, let's trade on Infosys and TCS, that's what I've been talking about. So our trade typically would be like, okay, and plus would be like buying TP and short TCS. Why? Pair trading, the aim is to select a stock that is going to outperform its peers. So we can say that Infosys is going to outperform TCS based on my statistical analysis, hence I am going to trade this. Contrary to the name, the statistical arbitrage, it isn't making risk-free money. Now when we talk about arbitrage, right, so something rings in your mind would be, arbitrage is something where you make a risk-free money. A risk-free money could be like, any arbitrage? Can you guys name?
So arbitrage cash exchanges, arbitrage cash exchanges,
good.
Futures and cash arbitrage,
Cash and future.
Currency from different markets.
Yeah. So an asset which is being trading, same asset, similar kind of say if it's a derivative contract, similar kind of a contract being traded at different exchanges, but which are having some kind of a mispricing. If we try and harness those mispricing and block it, then we call it a deterministic arbitrage. And the mispricing will lead us to the profitability. But the statistical arbitrage, what we looking out here is not a pure arbitrage, that is there are always risks of losing money. But what is that? The stats, which is the core of our understanding, the core of how we feel that the whole stock market or these two pairs will behave, will give us the competitive edge over others.
So one doubt is, like when you do pair trading, do you only look at outperformance or do you actually bet at long levels of correlation?
I'll come to that. Don't worry. I'm just giving you the basic starting of it. Means what we look at, why the correlation and what are the parameters. Okay. So let's look at the hypothesis as I talked about. We will be looking at market neutral strategy as a combination of two financial instruments. What is a market neutral strategy? A market neutral strategy is something like, if I am going Infosys long, so suppose I am going long for something like say 10 crores or say 2 million, so I will be also going short on the 10 crores for the TCS. Pair ratio of instruments are assumed to be fairly stable and implemented through pair trading. We'll come to that, what is the pair ratio and how we calculate it and how it's the behavior of it. It was first developed and used in 1980s by quantitative group at Morgan Stanley. This was the times when there were huge kind of movements in both the stocks, of both the similar kind of stocks, say like we are talking about Infosys and TCS. And these guys used to make something like 1–1.5% per day. And that was the amount of profitability, the money and the kind of things these guys were doing at that point of time. Slowly and steadily, as the market matured, the profitability in the US market came down, and many people have started looking at the pair trading from a very different perspective, and they started looking at how it can be made better. David Shaw, the founder, I think you guys might be knowing about him. David Shaw, the TV show company, left Morgan Stanley and started his own quant trading in 1980s, dealing mainly in the pair trading. So, if I talk to you about one strategy, if you say, which is being highly used in the hedge funds, in the various proprietary desks, and all over the world, is highly researched, means maximum number of papers, academic papers, if you look for, is a pair trading. Because everybody is trying to see, it's like elephant and the blind man looking at it. Okay, I can look pair, it's like this. Okay, I can go short, I can go long, I can look at this. So everybody is trying to getting an edge over each and every one. I'll show you what are the points where you can get the edge and how you really look for that. Okay, this is something what will happen. I'll share my real-time trading experiences with you, and then you understand is how this complex thing is getting played out in this world. So what we will be doing is selecting pair of stock that move together closely, wait until the price diverge beyond a certain threshold, and short the winner and buy the loser. Reverse your position when the two prices converge, profit from the reversal in the trend. Okay? So this is the whole process, and we keep on repeating this process as and when we go ahead. Okay, now let's begin. So to start with, I have taken two stocks, that's in ACC and Ambuja. I have plotted the prices of one stock on the one axis and the other stock on the axis. This is a period of 2005 to 2011. And what you can see, the prices of these stocks, two stocks, move quite in tandem. There could be slightly, these are the areas where the difference between the two have increased, but during some period, something like around should be March 2006, they have again came together, and vice versa, then again they moved ahead. So we will like to see something like here in January 2008. Excuse me. The prices have gone quite a wide apart, but they have come back together. So is there any kind of a trading opportunity that we can harness during these point of time, and what is something which gives us the edge, which we will be taking care here. Okay, so now here is something which I will be now taking to you through the whole exercises. What we will be doing is, we will be first calculating the pair ratios. So what's the pair ratio? Pair ratio is nothing but, say, price of stock 1 divided by price of stock. So in our case, it will be, say, ACC over Ambuja and Ambuja over ACC. Any of the things could be the price. So what I did is, I first plotted what is the ratio of the price, and with the price ratio, I have calculated the 30 DMA. What is 30 DMA? 30 DMA. Guys know 30 DMA? That's a 30-day moving average. for the pair ratio. Okay, so what I am trying to now see that if you look at this pair ratio has a tendency to revert back to the mean, right? At this point of time it went up, came back, went up, came back, went up, came back. So our whole idea would be here to look at the scenarios something like this. Say I take the pair to move something like this. So this is my mean. And this is 30-day mean. Okay. I am using 30-day mean. That does not mean that you should be always using the 30-day mean. It is something with a few parameters which I found useful while working with the various trading desks. That this comes out to be a really something which can give me some kind of a trend and came out of my parameterization, but it could be something which was fitting in for the period of 2008 to 2010. It could be very well different in 13. So it's just an illustration. So what I'm trying to show out here is what we do is pair trading is like this. So if you look at this part, that this is my pair ratio which goes beyond this mean. Is visible to guys? Yes. Okay. So what my whole aim out here is to find out these points that when my pair ratio has gone beyond my mean, and is there any kind of a high probability scenario that this pair ratio will come down, or here the pair ratio will move this side. Okay, so whenever I find and I am able to identify such kind of points based upon the property of my pair ratio and the pair, I will go and say the pair ratio is A by B. At this point my trade will be, I will be going short on B, A, and going long on B. Right? Because this pair ratio should decrease. Here the trade will be going long on A and going short on the B. So whole idea is that statistically, is it possible to find this trade? Few hedge funds have started working on area which they call it divergence trading. What I talked to you about is a convergence trading, because what we are trying to do is we are looking for the converge, where the pair is converging back to the mean. But what we can look for is a divergence also, which is here. That people say that this pair will move in this direction, not in this direction. But that is altogether a different area, which normally is done through the trend analysis. But what we are doing out here is, and has been done in the world in more statistically fashion, is your convergence trading. This points. Okay. So I will be looking all these points. Is that some way I can understand these points and able to harness and make profit out of that? Any questions on this? Now,
so how do you define that band which you have brought up?
I'll come to it. So that is, I'm just defining the problem right now. So this is first introducing you to what is pair trading. How you really do it is coming next. Welcome. Yeah.
Wouldn't the presence of more pair traders actually reduce your profit?
Yes, because it's always, because everybody knows it now. So there is something which I talked to you about. The more researchers are going into it to understand, okay, how can we act faster than that someone who is looking at it to get it out.
So is this usually done with very high frequencies, or can you take it as
It depends. It depends. I'll talk to you basically how your frequency of your trading determines the kind of profits you are looking for. Means how a high frequency trading determines your profitability, how a low frequency defines a profitability, what kind of things you should be trying to expect from a trading system. Any questions? Okay, let's move ahead. So the question is why the pair trading works. Means there should be, if I am saying out here that this price will come down here, means I am not a god, so that this can happen. The market prices are random. You can always come to it because it's random. How can you be sure, and how can you profit? You can say that you can profitably harness the situation. What to do then? Then we look for something which we call co-integration. Any you guys aware of co-integration? You guys know? Okay, so we'll touch on it, how it is being used in the pair trading. I'll just give you the mathematical definition also and how it is different from the correlation part. Once the spread diverges from its mean, the probability of reversal increases. That is something which we try to derive from whether the pair is competitive. With a chosen pair from the same industry and same sector, the extreme divergence from the mean are rare. See, when we are looking at the pair trade, we also, you can always ask me, I am saying trade TCS long, Infosys short, ACC and Ambuja. Why not say Reliance and on the other side say Tata Steel? Any idea about it? That's why we can always quantitatively look at, but it is not preferred. That is something which comes from the trading experience, and we look at the market not just from the point and understand the whole way. Any idea?
Because the performance of the industry, like if you have to come in the same industry, they're more likely to be highly correlated because they're dependent on the performance of the whole industry. So that's why these divergences are rare. You can also look at gold and dollar. They've got some good correlation. But then again, you cannot be 100% sure because there might be some external.
There will never be 100% sure, but yes, the fundamental driving the Reliance would be quite different from
You're saying Reliance and Tata Steel. Why can't you look at some defensive stock rather than a cyclical stock? In that case.
Yeah. So first, what you have to look at is what is something which is creating an outperformance in the other. What we are looking at is just a price points, right? We are not looking at that this as a cyclical stock. Maybe you can look at some oil sector, like oil Reliance or something, which is the oils are moving up, or maybe let's say Tata Steel, which is which I look at. So my whole idea, the idea in the pair trading is, or this is statistical arbitrage, is we looking at from the price perspective. And since we assume here that these two stocks have a similar kind of a fundamental move. So if a company, say, if I look at the real estate stock, if some information comes or some kind of a new policy changes comes from RBI regarding the interest rate, it will be affecting Unitech and DLF with a similar kind of movement. It is not that a news which will be very different for a Unitech and maybe a very different for say ITC, right? So these kind of information will just keep on coming into the market. If we have to really avoid the kind of whipsaws that is just moving haywire and getting your position in negative, then we use for looking out for the stocks in the similar sector. Yeah, there are some question.
So say if you're doing a pair between Hero and Bajaj,
right?
Typically what's happened is over years we've seen last decade or so that one eats into the market share of other, the other one eats. So the stocks react accordingly. But then suppose there is a third participant, say Hero comes, Honda comes, and that relationship breaks down because there is a third player who is eating into the market share. So the markets will factor both these factors, so both will perform negatively. So this relationship won't hold true in such cases.
See, okay, what the question you are saying is, first of all, the market share of, if I look at the Hero Honda in the specific case, in India the market itself is growing up. So they both are not eating up the market. Say Hero Honda is eating up the share of the Bajaj, right? And if you are saying that these kind of things are there, what we are looking at is a temporal price changes at a given point of time. Say if I look at the pair trades today and 15 days or say 20 days, which my typical holding period for the pair, by that time this information which will not be materially different in terms of the market share being taken up by one firm to the other firm. Okay, so that way that the big fundamentals do not change.
So what's the time limit, time length actually which you consider?
I'll come to that. See, the time limit depends upon certain other criteria which you are trading horizon, right? That's your question. I'll come to that. How you decide upon a time horizon, or maybe you are not deciding upon, it is something that comes to you. What is the thing which makes you decide your trading horizon is something I'll just talk to you about. Okay, let's move ahead. So pair trading strategy, I'm just first taking you through the whole what is the theoretical part, and I'll show you some Excel and we'll do some work on co-integration, how the co-integration really works, and we'll discuss about it. So it's a theoretical part, but it's very important because it's a whole process through which we go about it. Your first pair trading strategy requires few key decision points. The decision making algorithm is the first thing. A decision making algorithm is something like, first we look at, okay, in our case we will be looking at whether the pair is co-integrated. If the pair is co-integrated, which is giving us that this, I am assuming you guys know about the co-integration, right? So maybe I'll discuss it a little more, but it is a property through which that the ratio has a capability that, or it's a property which that it will come back to its mean. So that is a co-integration. So we know that, okay, if we're looking at the ratio which have gone to extreme, will come back to its mean depending upon the way we trade. The second decision making algorithm would be something like where, as someone has pointed me, means how I decided this band, right? So we'll also look at into what are the various ways you decide upon these bands. So this will be our decision making algorithms. Market timing, then we decide upon when we should be entering, when should we be exiting. Here I would like to talk to you something from my experience. Like in many trading strategies, many guys will say to you, okay, this is an entry point, you should enter, but not many people will talk to you about the exits. Those guys who have traded, can you share some experience about your tradings? Yeah.
Plenty of times when I didn't have, like initially when I started, I used to have an exit strategy in mind.
True. Okay.
Now I make sure that when I enter any stock, I have an exit target price.
Exit target price. How do you determine your exit target price?
I usually just take a percentage. So if I expect to earn 20% from the stock,
okay,
and then I follow it up with a trading stop loss if it reaches that 20%.
Okay. Any other person about your trading?
Check the resistance level at which the stock has reached.
Okay.
So that is my target price.
That is your target price.
And if there is another upside, then next resistance.
Okay.
First of all, look at what was the reason I bought it. Like whether the results were bad or something,
True.
I bought it. And my time horizon might be a longer period, like for 6 months, 12 months. Then I keep a range of about 35 to 40%. I should get returns from that. Usually, when it's short term, it's basically 15 to 20% on that in each stock.
Okay. So that is where, that's how you decide upon. So coming to a bit of a point, which I'll come back to that. You used some words which I'll come back how you should be deciding on it. Except, yeah.
So depending on the time horizon, we can also look at the long levels of volatility in the stock, and like depending on that, you can actually see where you can put a stop loss, and you can also see like what the target could be in the best case scenario. So based on those two parameters, you can actually judge when to sell the stock or when to buy.
Okay. Yeah. So there you talked about various ways of how you exit your position. Okay, let me talk to you something about it. See, when we enter a position, we have some hypothesis, right? As I talked to you about, you enter a stock, you say because we talked about like the quarterly results are good, I'm going to enter. You find some kind of a say indicator or technical indicator or something. Somewhere you enter your stock. We are good, but have we thought whether that hypothesis is holding true as we move ahead in the time period?
I mean, if we're looking at something like technical analysis, that's the whole premise is that the past predicts the future.
That's fine. My whole point is, like, see, it is more like you say that if I talk about pair trading, let's come to this point. Okay, what we will be looking at, I will be looking at the scenarios. Let me use that part of the board now. We are looking something like this pair, right? I am here, and this has been something like my band. This is my mean. Is it visible to all the guys? Now, here, the probability is that either it can come down here or it can go up. True? This price can go up here. Now, I have initiated my trade here. I would be making some loss here. Now, should I exit my position or not?
Yes.
Somebody will say yes, somebody will say no.
It depends on the risk
capital.
Stop loss strategy.
It
And
depends
then
on
I
the
have a
risk
stop loss in mind and it has crossed that stop loss, I should get
That is about your risk management.
Yeah.
Very true. Fair enough. But is there some kind of method, I would say, which is more scientific method? See, your stop loss, your risk management of say rupees 100, this would be 200. We know that it has gone up, but it can come down. Right? You will say, no, I'll handle it 200. What differentiates his versus your trading strategy?
risk appetite.
It's a risk appetite, right? I take you to another concept here. See, your how I put it this way. Suppose you are trading 100 lots and you was trading 100 lots. Your was 100, your was 200. Okay. Now, if you would have reduced your lots to 50, you could have taken to the much higher points of these. So that does not make your exit an optimal strategy. Did you get the idea? That reducing your position size, you could have taken the more higher sides, right? Now, where I am coming from business, when I was working with Advice, I used to advise clients on pair trading. Then this was my whole area. And suppose I have given them a trade of say, okay, go buy ACC and Ambuja. I, as a normal trader, used to have something like a stop loss 4%. That is something a big, that is on the notional amount, and that's quite a big stop loss if I am putting up $1 million or $1 million here and there. So I used to give my advice to clients, okay, now this stock has gone 4%, this pair has underperformed by 4%, you should exit this. Then this client of mine used to come and say, now execute my trade. His trade used to be the opposite. Did you get? Let me talk. Here I am saying, say, buy ACC and sell Ambuja. This was my trade. Here I stop loss at now saying squaring of ACC and Ambuja. This guy used to say, no, I will enter my pair out here. So my stop loss was his entry point. Though his points were quite less, but since these points were quite far and very low probability of these occurring in a year, but they used to give a huge amount. So what is something, yeah.
So isn't it same as the technical and Bollinger Band which you
Yeah,
use? When you go outside the Bollinger Band, you basically you know that the trend is going to remain reverse.
Yes.
Yeah.
True, that's what I'm coming to that. That's a kind of a Bollinger Band only. What I'm trying to draw out here, that will be something we'll talk. But how you decide at what point is the question.
It's like how much is your risk appetite? So basically,
No,
how
it's not just risk
How much is the
appetite.
deviation? How much is the deviation?
That is again something very subjective now. I will talk to you about. See, the thing is, that makes a difference out here. See, what I am looking at is that this is away from the mean. Fine, it is quite, this scenario is quite a low probable scenario, right? And this is again a very low probable scenario, it's away. I will check whether my co-integration is still holding true. If my co-integration is holding true here and here, this trade makes me ideal to take this trade. If my co-integration is not holding true, then I should not take this trade.
Would you take the opposite position?
No, I will not take any position because I am not very clear about the pair. Because what I am saying is then, see, what I am saying is then, if my co-integration is breaking, then this mean, which I assume to be stable, is trending. This trending, I do not know where it will go. So if I do not know where it will go, I cannot trade.
But then why can't you execute a divergence trade? Because then, see, if you...
Again, that is more something which is not statistically happening. Understand this. See, this is not statistically, you can... I am saying that it will mean revert, but whether it will mean revert or it will get back into the mean reversion after some time or move into divergence, I do not know. Once the co-integration is broken. So whole thing comes down to this, that whenever you are doing any trend, you should always have some kind of indicator which should be giving you an idea whether your trend is still holding true. A resistance method could be something like which is giving you that an idea that now the trend is weakening. So you use resistance as a hypothesis that my hypothesis of trend in the market is getting negative. You are getting? So your stop loss points are those points where your hypothesis get negated. You say that okay, you look for some kind of a forward P, and you find it out that my stock price should move up from this point because of these forward P is getting revised. It moves up, okay, fine. But how this hypothesis get negated when some kind of other information comes into the market, say that forward P get either revised downwards or actual P is coming to or whatever. I am not more kind of expert on those side, but there is some kind of information which enters into your system which says that your trend or your mean reversion is now getting negative. So why you are holding your points? So your all exit points are should be based upon your hypothesis getting negative. बाकी जो all risk managements are always managed. Assuming you are trading something like 10 lots or something like 10 shares. So if you are fearful of losing 100 rupees on 10 shares, you can always increase it to 205 shares. Right? This will make you the same amount of money, losing the same amount. True. But here it will give you more space to hold your position. So you should always know whether your hypothesis always remain holding or whether your hypothesis is changing. Did you get this idea? So that's how you should look for the stop losses. Yes.
So your main hypothesis is that the co-integration will hold true. Only then can you shift the position. But actually shifting the position, going long short on one stock and then going long short on another. How do you decide on that? Like
that is something, yes. How much I will be using a parameter for it. I'll come to that. But did you understand how you define your exits?
Yeah.
See, exit is not just risk management. Yes, there is a risk management. You can look at it, how much money you are losing if you do not have a proper understanding or proper information flow of whether your trend or your mean reversion is negative. But if you do not have, then okay, you can use some kind of a fixed stop loss of 100, 200 rupees or something like that. But if you have the full information of how the things are moving and what is your statistical parameters or your technical parameters, should also give you idea whether the trend is changing or not.
So one more thing, when you look at co-integration, suppose if I am trading in SBI and in Bank Nifty, the correlation will always hold true because SBI.
Correlation, we do not look at correlation. I'll show you why the correlation does not work in pair trading. We'll come to that. Okay. Okay. Now the second part is the optimal position sizing mechanism. Now I think you can appreciate this point. That's how your optimal position sizing will change the amount of loss you are making. So if you are not very sure about the probability of reversal, you will position your size in such a way that you do not take that much amount of position. Spotting the scarce opportunity, that is something like the pair trade which I am discussing is on the daily basis. Something I am taking on daily basis means I am taking the daily data, and these kind of trades you won't find not more than 7-8 trades over a year for a particular pair. It could be a few stocks will be giving you higher pairs, few stocks will be giving the lower pairs. So, excuse me, this opportunity is quite scarce. Okay. Statistical arbitrage is not a risk-free strategy. Key risks involved in trading are as follows. Rather than converging the price of the two securities begin to diverge, drift away, the spread picks up trend rather than mean reverting to the original mean. I think it should be clear that now the spread can start moving up. Sometimes an event in a security can trigger extreme movements in the pair ratio. Entering into such a security trade should be avoided. Okay, I'll give you an example on this point. Do you guys follow market actively? Okay. Let me give you the very recent example is of HDI. Have you guys followed the story of HDI? Right. Let's look at from the perspective of pair trading. Okay, this is a real estate stock. You can say, okay, I am going to look at the trade of DLF versus HDI, right? Now, when you are looking for DLF versus HDI, suppose you are looking at DLF over HDI. If you would have following the pair ratio, you would find at that particular day the pair ratio would have dropped like this. True? Yes. By any measure, if I have any kind of a mean or some kind of a band,
Increase, right?
Pardon? Oh, sorry. It will increase, right? So by the any measure of my bands, this will be having a kind of a behavior that will be showing, okay, you can enter this pair, you can enter this pair, right? Because it has gone from the mean quite far, right? So should we enter this trade? The system says we should not enter this trade because there is some kind of an extra information or some kind of an event which is happening into the stock, and we should avoid those stocks because you never know how much far this pair can move beyond the mean. Similar thing is like in 2009, if you guys remember, was the Satyam case. As I was in the market, I was trading. Now I usually don't trade much, but in Satyam I was trading, and Satyam was something like 174 when the news came, and that stock started dropping. Means my senior was something like, you should go and trade this pair. It is now something like Satyam was something like 140, 120, and Infosys was rock steady. So he said, okay boss, go and short Infosys and buy Satyam. I was no, because there is an event into it and you never know where it's going to stop. And it went down and it came down to something like 25 rupees. 6 rupees. And something that's stable for the day was 20 around. So by that time, if I would have taken any future lot, I would have been over. On that day, so much of the margins would have been hit. So the whole idea is, it's not just quant, but you should have you should have some kind of risk check whether to enter this pair or not. A risk check would be something like either you have a news flow, or another risk check would be what have been the recent price change. If the recent price change has been something like 5%, 10% in a single shot, then you look for, let me look at into the stock, otherwise I will not trade it. Fine? Strict risk management of stop loss is required to handle the adverse situation once the mean reverting behavior is invalidated. Fine? Now you see what I was saying, once your mean reverting behavior is invalidated, that is your co-integration test fails, then you look for the risk management, because now you say, okay, now the things are gone, even co-integration has failed, let the risk management come into the picture. Okay? Any questions on this? Risk management on trading? Pair selection criteria, qualitative selection. Stock should be from the same sector, industry. I discussed about why. The stock should have a similar market capitalization, essential to ascertain how much amount can be deployed without much impact cost. I would also like to put up is similar market capitalization and impact cost. Let me give you an idea about it. Now you guys must have traded in terms of like on an individual capacity. Once you guys will move into the corporates, you will be asked to trade on the bigger quantities. A quantity could be like your boss will say, okay, go and put 2 million on the long one side and 2 million short on the other side, right? Then you will be faced with a scenario. Your pair comes out to be something like, say, SBI and excuse me, SBI and Bank of India. Do you think you will be able to put up $2 million notion, your margin amount, where is something like you have around 20%, say, assuming your margin amount, and for notional position of something like 10 million in Bank of India without moving the stock? Didn't get. Okay. See, you have to trade in SBI. I think it's.
Yes.
Can I click this?
Yes, sir.
You have to trade in two stocks, say SBI, okay, and Bank of India, that has a point. You have to put $2 million margin here, 2 million margin here. That will be something like, if I take the ratio of something like 3 times leverage you can make out of it, that would be something like 6 million here and 6 million here. Okay. Now, if you are taking a 6 million position in a stock like BOI, BOI is something which is a small stock which is not much traded, but follows everything. Your co-integration is good, your pair is away from the ratio by what not criteria you have, everything is there. will you able to deploy your money? No. So it becomes very essential to look at whether these two stocks have a similar market capitalization. I am taking a market capitalization as a synonym for the impact cost. So if you have a high impact cost, you will not be able to deploy it. So if you want to trade you have a big amount. See, for a big fund, 2 million is nothing, right? So for them in Indian markets, our number of pairs remains very small. What you can do is you can trade SBI with ICICI Bank, ICICI Bank with Axis Bank. So you do not have much an option left once you have this market capitalization criteria comes into the play. Okay, so it becomes important from the fund's perspective. Correlation. The price returns of the stock should be correlated. Yes, we will as we talk about, we will talk about the correlation. What is the difference between the correlation? Correlation is not a sufficient condition. It could be necessary, but not a sufficient condition for looking at better pairs. Why? I will tell you. Cointegration, price should be cointegrated. Perform the Dickey-Fuller test statistics. I hope you know about this stat. Dickey-Fuller. Okay. So it should confirm the Dickey-Fuller test. Okay, can someone talk to me about what is cointegration?
In layman's terms, it's when you have two stocks moving and it's like one man is holding a dog on a leash.
Wow.
And it's moving around.
And that's a very good example. I always use that. So what do you find out of cointegration?
Basically, they move together but not always in the same direction. And they have a little range in which they would be moving together.
Can two stocks have high correlation and high cointegration?
Yes.
And can a high correlation means high cointegration? Okay, good. So how you calculate cointegration? You know about the methods?
You take a unit group test, which is the augmented Dickey-Fuller.
Okay.
And then after that, there are two more steps we have to do.
Trending. First you do trend.
Yeah, I think there was trending.
Okay.
I don't remember.
Okay. Anyone?
Johnson?
Huh? Johnson is there? Test. Okay.
NGO.
Okay, fine. So I think I should not, my PPT had quite a lot on the cointegration test. So I will not take much upon time. Let's talk more about the trading part, right? That you guys will be more interested upon.
So you can cover cointegration also.
No, I will cover that part. Because not everybody, but since I think many of you understand it, I will cover that part. But I will look more into the trading part, which is very practical oriented. Second is the volatility of the stock. So how you look at why you need to understand the volatility of the stock? See, again, let me come back to the trading example. Those guys who have traded, let me take the example of two stocks. One stock which is one of my very favorite stock is Axis Bank, and other I look at the SBI. So if you take these two stocks, what you can see, so any idea what which stock is more volatile?
SBI.
SBI.
Right now SBI.
Right now SBI. Okay. So what happens? You have to look at the volatility. How the volatility affects your pair trading is like this. Suppose, let's take SBI, and you say SBI is highly volatile. Okay. And then say I look at ICICI Bank. Say assume it to be low volatile. Now, if you enter this trade, suppose you enter buy SBI and sell ICICI Bank. This is your trade. So what you are assuming out here, the SBI, which is right now not either moving or which is falling right now, will move up, and ICICI, which is either move down. Fine. Suppose if your SBI is moving down, and with the some kind of, since you find more volatile, you see some kind of big uptick. Oh, sorry, downtick. It can take your position to the negative. Although this thing reverse like this. Normally, when you have these kind of V-shaped falls in the market, you have V-shaped recoveries also. So these kind of small extreme movements on a smaller time frame can hit your stop losses. So the volatility of the stocks becomes a prime important. Why? When you are deciding upon your stop loss, you know that if I have to play this stock, SBI has this bad habit of extreme movements on which times my ICICI would not respond since it's a slow stock. Hence, I should make provision for these kind of movements if they are coming. Okay? So, the volatility of stock is to be taken care of when we are trading pairs. Historical return for a particular pair. This is very simple. What we have to look at is that historical returns are looking at what have been happening in the back testing. Until there's a pair works out well in the back testing, you will not find it out to be very well. Is there anything unclear?
No.
You can discuss with me.
Can we hedge the volatility? That's what I'm wondering. Using options.
Okay. See, when what you are doing about this pair stocks, when you look, few people have asked me that okay, if I am trading SBI and ICICI Bank, why not I trade using options? Yes, you can do it through options, but in options, suppose you are taking this position for 2-3 days, right? Then you have to also keep looking at what is beta. I hope you understand beta, all gammas, all
Options like we can hedge Vega.
So you can hedge Vega, you can do it. It's not, but there is an extra level of complexity over it.
Right.
You should know. See, there is not. You should not do it. All my idea about out here is to you should know what you are doing, because many a times in life we do not know what we are doing. We just keep on doing. So what we are doing is something you should know, and that is that volatility is there. So I should hedge this. I am doing this. I should. This could be this kind of a result. That should be known. Okay.
So, but in this case, if we do hedge it, the transaction cost itself will be very high because in paid trading.
So that's why. Then you have a cost benefit analysis.
Cost benefit, because as it is paid trading, they don't earn you phenomenal return. And if you use options to hedge it, it will further reduce down the profit. So I think that's the reason why they don't use hedging in paid trading.
Then you have to live with this volatility. So either you live with the volatility or you hedge. So if you want to live a peaceful life, you have to pay cost. So that's the fundamental. If you want to be peace, then you have to pay some cost. Peace determines some cost. So that is the cost. Are you willing to pay, or you wanted to live with the open position and enjoy? That's up to you. Okay, but you should know that you will be facing these things. Okay. Historical returns, as I talked to you about, because we have to look at the back testing of this pair, how the pair is behaving in the in its past and how its behavior will be in the future. To understand, we look at the historical returns and the cost of a transaction. As someone pointed out that if the hedging is coming out to be very costly, I will not do it. Right? Yeah. Okay. So let me talk to you about something upon the Cointegration. So pair ratio need to be stationary process. So anybody can talk to me about the stationary processes? Oh, so much.
There are basically two types of time series stationarity. First is called as stage 1, wherein mean and variance of the series is stationary. Second is called as stage 2 stationarity, wherein mean, variance and covariance of the series will be stationary.
So why we are looking for stationary out there?
Random and not.
Okay, yeah, you're right, mathematically right. What was your first statement?
So there are two types of stationarity.
Yes, slowly. First stationarity, let's look at this.
Two types of stationary processes are there. First is called as the stage 1, wherein mean, variance process is stationary.
Is stationary. What is mean stationary here? When you said stationary is mean, variance are stationary. What is stationary here? Anyone else? Yeah.
They don't vary with time.
They don't vary with the time. Okay, so how is it now you find where how it is useful here?
So the ratio will be constant. So the ratio should remain consistent if we are
Mean of the ratio. So if your mean of the ratio is stationary, right? Excuse me, hello. If your mean of your ratio is stationary, then whenever the price ratio moves much above or much beyond your mean, then isn't that it has a probability of coming back? Because your mean will remain stationary by the definition. So what should come back? Either your mean should move there, either this, let me come here. this mean should move here or this pair ratio will come here. But by definition, when you have put up that this is stationary process, then किसको नीचे आना होगा? भाई mean को pair ratio आना पड़ेगा. So let's make money out of it. That's the whole idea of why we use pair ratio as a stationary process. What is stationarity? As something we just one of us pointed out to stationarity. Now understand the stationary that remains same. Do we need stationary test? Do we need to test for non-stationarity? Stationary or otherwise, the series can influence its behavior and properties. Persistence of a shock will be infinite for the non-stationary series.
So if it's non-stationary, that would make a case for divergence trading, right?
Yes, you can try it.
Because then it would imply that there's a trend.
Very true. But then you do not know where they will trend.
Yeah, you don't know which direction it will go, but I mean, again,
yeah.
So when it is non-stationary, the mean will not be remain constant. So we don't know the direction. Then how we will trade?
That's what I'm saying. That's what it is. So how will you trade? You do not know because your probability. See, what our idea out here is that probabilistically we should be on the right side. Okay. So if you ask me that I'll give you 5 pairs and you will make money out of this 5 pairs, no. You don't know. Okay. Let me ask you a very simple question. What is the difference between luck and probability?
Luck essentially defines a portion of uncertainty which may or may not be measured. Probability is essentially a function of risk which is quantifiable portion which can be measured.
Okay, one more. Simple language.
Essentially, luck is some uncertain portion which essentially cannot be measured.
Okay.
And probability is the quantifiable portion which can be measured.
But probability might not be the same. Ex ante probability means you define a probability. Ex ante probability will not be different, so it can be uncertain. So,
in active portfolio management, you have ex ante probability is equal to sigma upon
okay.
omega I upon sigma.
What else? What can someone be more clear?
That is confirmation of probability of occurrence of an event.
Luck is a confirmation of
probability of occurrence of an event.
Okay.
So maybe luck is the occurrence of an improbable event, something which you didn't expect to happen with the condition that happened.
That will say unlucky or lucky. Okay. Chalo. What anybody would give a try on this? Means how the luck affects us. Means we say, oh, he's lucky, and we say, okay, maybe so. This probabilities will also change. And the happening of a luck also change.
Luck is 50-50 probability.
This is
Okay. Luck is 50.
Yes. So, okay, come back. Let me give you a trading example of how you define the luck and how you define the probability. See, you have a chance of making one trade right out of 100 trades. Okay? By probability, this your probability is 0.01. Fine? Okay? Now you give 100 try of that trade. What can happen is you will get one trade out of this profitable. Your probability is walking. But that 1 winning trade will be the first trade or the 100 trade is your luck.
Yeah.
Why I want to bring this concept here as difference between luck and probability is in life or in every life and something I am looking at life from the trading perspective also. What happens is we have for certain trades we have some probability and we do not give enough trials for that probability to come out. Did you get the idea?
Yes, sir.
Sometimes we say that, oh, for them these things worked out. Oh, he is lucky. But if you would have given that number of trials for that particular thing, then by your probability, maybe because of some skill could be different, but your results will also come out. You understand the difference? So, in pair trading, if I give you 5 trades That does not mean by 5 trades, if I say my 20% trades are right, then you will get 1 trade at right. You will say, you are giving 5 trades, all those 5 trades are negative, what are you teaching me? Dude, I am not giving you something which will directly follow that. So what you need is to see your whole number of trials. And that goes with everything. Okay? So where I was, okay, I moved into different thing. So that's why what I want to point out here in trading, whenever you are looking for any kind of a trading strategy, you should know how much probability is there for your trading strategy to make money and how much money, and you should give it enough trial. And so is with your life. If you have anything to try out, you should give that trials, and you should look for what is the amount of your success probability in anything. Okay, coming back to this. So non-stationary series. Model 1 can be generalized to case where YT is an explosive series. If this YT is equal to mu plus phi, YT minus 1 and phi is greater than 1. I think that is something you guys know. Is anyone have a doubt about this? How this series, you do not know whether it will come back. Okay. What is cointegration? Cointegration is the foundation upon which pair trading, that statistical arbitrage, is built. If two stocks simply move in a correlated manner, there may never be a widening of the spread. Okay. Without a, did you guys understand this? Yes. Without a temporary widening of a spread in the either direction, there is no opportunity to short or buy the spread, and no reason to expect the spread to mean reward. So the essential thing is that we are looking for that spread. There should be some spread. Okay. Suppose there are two stocks which have. Suppose there are these two stocks which are highly correlation. So what a high correlation means? Can somebody explain to me?
Move together. So I mean, if you have 0.99 as the correlation,
okay,
that means 99% of the time,
right,
the two stocks will move in the same direction.
So one is up and the other will also move up.
Yeah.
Right?
99% of the time.
99% of that time. Okay. Good. So if I give you an example, like let me show you this. These are two stocks which are more on the, these are generated by I'll show you some. Suppose there is a stock. Okay, both say are valued at 100. And suppose this is day 1, day 2. It's difficult for me to work on this. Okay, so let us look at these two returns. What do you think about the correlation among these two? Suppose these are the returns for this stock A, B on different days. This is day 1, day 2, day 3. This is point 1, point 2. I think it's visible. and the other stock is moving by 1%, 2%, 3%, what do you think would be the correlation out of it? 1%? Sorry, 8%? 1? Okay? So you can say, oh wow, these stocks are very highly correlated. Do you think these stocks are coming together? Or will they come together?
No, they probably will diverge out.
They are diverging out. So can your high correlation will be the matrix of the pair trading?
Yes, I mean that's why you need co-integration, right?
Yes, that's why.
This divergence is not counted for. If the stocks were co-integrated, this divergence wouldn't have happened.
Wouldn't have happened. I think like one of my friends has asked whether we look for the high correlation. So this is the reason. Okay. The other one was also the stock. Let's come back to the. See, you can look at correlation also. Let me give you an idea about it. I think this could be an exercise for you once you go back and you check it out the pair trading. See, what we are looking at is that in any given pair, these stocks have been moving together. At particular point of time, they have started diverging. If they are diverging, then their pair ratio is diverging, right? So can we look at something like this? What was the correlation before 10 days before, and what is the correlation right now? Do you find that the correlation might be coming down or going up?
I don't.
Check it out. Whether, suppose two stocks who move together, now they have started diverging. You guys getting it?
If they started diverging, correlation.
Now look at the correlation, guys.
If the stocks are diverging and they used to move together, then obviously the correlation is reducing.
Right. So the pair trading would be then looking at something where the correlation is reducing rather than increasing. Getting the point where I am taking you? That if the pair is you are moving ahead. Okay. Yes. If your pair ratio is diverging, that means that the stocks are not moving together. Means if one stock is moving up, the other stock is not moving up. So your correlation should ideally be going down. Check it out whether it works this way or not. So this could be something which you can take the two stock prices and try and find out whether this kind of behavior is occurring or not. Okay? So correlation, if two stocks are correlated, if stock A has an update, then the stock will be having an update. That is something we look at. Cointegration, I try to look to the two correlated stocks. You will find that they have a similar kind of created by some random noise and all. So these two, the difference between the two is diverging. The one which I created was a very simpler one. Just direct one has a correlation. This is not having one as a correlation. Cointegration, if two stocks are co-integrated, then it is possible to form a stationary pair from some linear combination of stock A and B. That is the definition of cointegration. Yeah. Any doubts on that? Okay. So just give you an idea about how we calculate correlation, calculate the log return of the individual securities. Any of our ideas by the log returns? We are asking you to calculate the log returns. Yeah, that means log returns of the stock price of a stock. Means this is something like price of today divided by price of today.
The logarithm scale essentially smoothens out the.
That is something more of usual. Yes, you are right. So that is something like 3t minus 1. Okay? Minus 1 will be giving you the returns, right? I am saying to calculate the return like this. You know that? Yes. Right? Why we calculate log returns?
It normalizes the scale, right? So if you have one stock that is going up in the past 10 years, it won't be reflected, the growth of rate won't be reflected accurately on.
But the log returns and normal returns will be the same. No?
Yeah, the log returns will be the same.
So we use it because your prices, they cannot go negative. That's the one of the
Right,
reasons
right.
I
Basically, we are assuming the return price to be log normal and the returns to be normal distribution. That's why we use the log return. Okay. Coming back, we calculate the log returns. The Pearson's correlation, that is your normal correlation. That is a technical name more. Pearson's correlation for the two securities can be calculated using the Foreign function in Excel. I guess you guys are familiar with using of the Excel. Example for ACC and Amuja correlation for this period. Jan 06 to 29 December, that is around 1 year period, is something like 0.74. And just try to plot the graph. Okay? So, what is cointegration? If there exists a stationary linear combination of non-stationary random asset price, the combined prices are said to be the cointegrated. Okay? So the two stocks, as he was giving the example of a man and a dog, the man and the dog, can you repeat the full example please for us?
Two stocks are said to be cointegrated if one basically is looked at as a man and the other one is looked at as a dog and they have a leash between them. So basically it will revert back to a particular mean.
Okay.
Despite them diverging.
True. So it's like this, a man is taking his dog for a walk, so man might go with any random path. The dog can also go the random path, but the distance between the two will be tied between the distance of the rope it is there. Right? So the amount of the rope it can go, the dog will be going that path. Take your pair something like that, this rope is elastic rope. Right? So the pair, the distance is not constant, the distance can always increase and decrease based depending upon because the elasticity of the elastic you are using, and it can even break when the dog becomes wild. So when the Satam goes wild, your HDI goes wild, you have breaking of the relationship. So we look for that is the cointegration breaks at that particular time. So what we are looking at is these are the two non-stationary random asset prices, because the mean for both the stock is changing, the variance is changing, so it is not stationary. But if they are combined such that their prices are stationary, we call them cointegrated. Another way is spread are between two sets are mean reverting, tied by common stochastic trend, then price are termed to be cointegrated. Just another name. Another very commonly known processes are cash and future. Understand cash and future? That's your equity, your stocks, and the future. So whenever if you look at your future prices, the future prices will be in the premium or discount normally?
It will be both, it depends on whether it's
normally, that's why I asked you. That's why I
the positive cost of carry.
That's why I add the word normally. Means in the higher probability situation, so they are always positive. But you will not see that the difference between the two is going beyond 1% or 2%. 1% or 1.25%. What happens, the arbitrageurs will come and try to close that position because it is something more than the cost of carry they are making, and hence they try to make benefit out of it. So the arbitrageurs are doing such a job that they are making them correlated, so co-integrated. So this is a naturally occurring process, cash and future. What else you can think of? Some other? From this side, we have so many. What you can think of? Some prices, processes, stock prices, or some which could be. Guys, awake? I know it's Friday evening and everybody is. But yeah, I think talking to something interesting which will help you out going ahead. So what do you think? You can very well say something like prices in NSE and BSE. Means they might have some kind of a movement which is at some point of time different from each other. The prices will be different from each other, but they will converge together. They will always remain together. So you can have that kind of a thing. The stock is in the same industry and same business model. That's what we are talking about in pair trading. That is the cointegrated process. How are they useful for pair identification? Not just the return, the price movement of two scripts should exhibit similar kind of drift. That is movement. Okay? Process of determining cointegration. Techniques used to identify cointegration are Dickey-Fuller test, Angle-Granger to process, and Jonassen test. I'll just give you an idea about the Dickey-Fuller, which is very commonly used. I think many of you are now feeling sleepy. Let's have a small break out here. So you get to freshen up. We can take you forward.